So this is the start of this trading course, and the first thing we're going to teach, or I'm going to teach you, is liquidity sweeps, because that is the crucial step one of any model that you're going to trade as an ICT trader. It is also the model that got me my first AMG at 21, C63S, and also $1.5 million in funding. So I'd be listening very carefully to what I have to say. Whether you're a beginner or you've been in the space for a while, you probably heard what liquidity is. It is essentially any high or any low in the market. So this is a liquidity level. This is a liquidity level. This is a liquidity level, and so on and so forth. This is also liquidity. So it's essentially where market makes a high or a low that sticks out to you. That's the easiest way to spot liquidity. Now, those highs and lows that the market makes are going to act as a draw in the market, meaning the price will go to those highs and lows that you see. We're going to get into some live examples in a second, but just so you guys have the fundamentals, I need you to understand that any high or low is liquidity. And what is a liquidity sweep? So let's say that we have a high here that market has created. Now, if market comes above that high, okay, and then has a reaction back down, this is what we can call a liquidity sweep. When we go above the candle and then we come back down. Now, just like how market came to this candle and had a reaction off of it, we're also going to be drawn to the opposite side of the curve. That essentially means that the opposite side of this high is this low. And when market takes a high, it's probably going to go, if it's a valid liquidity sweep, if you see a reaction, it's going to go towards that low. And your job as a trader is to recognize if this liquidity sweep is a valid sweep or not a valid sweep. And that's what I'm going to teach you throughout this course. Why that works is because liquidity levels are essentially where market rests a lot of orders. So that just means that at any high or low, there are a lot of stop or buy orders that market has. That basically means when market goes to a high or low, it's probably going to have a reaction, and you can take advantage of that reaction. So last night is a perfect example because I made 2.7K live. If you want to go have a look on my Instagram. Using this exact concept, I do it every single day. Right now we're on the 4-hour time frame, and this low is the most prominent low you can see out of any of this price action. So this sticks out, and this low has not been taken yet. So price has not come below it before last night. So when I see market open, now you're only going to want to do this at market open. You can do it at any other time, but if you want the best results for liquidity sweeps, market open is a really good time. Because every single time when market opens, we usually go ahead and sweep liquidity of some sort. And after we sweep liquidity, we go below a high or a low. Okay, we're going to have a reaction at market open, and you need to take advantage of that reaction. So market open at 9:30. So before 9:30, we were around this area here where my mouse is hovering. Okay, so when I'm there, I'm like, okay, well, we've been coming down all day, and we have, we haven't really had a retracement back up, meaning there's a lot of highs here, as you can see, that have not been swept. Now, when I look at a lot of highs not being swept, I want them to get swept, and market usually sweeps them. So when I'm looking at these highs, I'm like, okay, well, these are probably going to get swept soon. What has to happen before we sweep these highs? A liquidity sweep, okay? Now, that liquidity sweep last night was on the big time frame, meaning the 4-hour time frame had this big low. 9 out of 10 times when we sweep a high like this, we're probably going to have, a low like this, the one I showed you, we're probably going to have a reaction on the other side. When there are a lot of highs or lows in a line like this, some people call it trend line liquidity. Okay, some people call it low resistance liquidity. But all you need to know is when liquidity looks like this, so a lot of highs generated without them being taken, market will most likely come and take some of those highs. But before it takes some of those highs, what has to happen first? A liquidity sweep in the other direction, which is what I waited for last night, okay? So after I saw that we swept that low, meaning we came below it, and then we started having a reaction up, I wanted to take advantage of that move. So as soon as we had a bit of a reaction up, okay, now I'm going to go through this model, why I took this later on in the course, okay? Because a liquidity sweep is just one step of the process. But as you can see, I took advantage of that and I made 2.7K and I made that live. Okay, so now that brings me to point number 2. Point number 2 is that you can see that we don't have one low here, we actually have 2 lows. Now, when we have relative equal lows like this, meaning 2 lows very close to each other, okay, what market usually does is it makes this an even bigger draw. The more lows there are lined up, the more likely market is going to go there. So if there was one low here, I'd still think market is going there, but 2 lows just confirms my bias that we're going to go down. Now that brings me to point number 3, and this point is going to explain how time frames determine liquidity. So liquidity moves the same on every single time frame, the 4-hour, the 1-hour, the 30-minute, whichever time frame you go on. What that basically means is that this here, I am on the 1-hour time frame right now. And this is a 1-hour liquidity sweep. You know, you don't have to wait till price comes all the way here to sweep this liquidity to see a reaction. You can see internal highs, just like this high here, to see a reaction to the downside. It all matters on where the draw on liquidity is, meaning where price really wants to go. Now, in this case, price really wanted to go to this low. But what has to happen before we go to that low? We need to have a liquidity sweep, okay? So step 1 of the model is always a liquidity sweep. When I see this, I'm like, okay, well, we're having a reaction after taking this high. Where would we want to go? And we would want to go to this low because that is the most prominent low that we have in this area. So now I'm going to show you something really, really cool inside of this model, okay? So I want you to keep in mind, this is a 1-hour model, okay? 1-hour liquidity sweep going to that 1-hour low. What you can do in that same model is you can zoom into the 5-minute time frame. And let me just scroll to the same point that I was on. And after I've zoomed into the 5-minute time frame, I'm actually going to see something really cool. On the 5-minute time frame, we have this liquidity sweep, okay? Again, the 1-hour time frame was this one, but on the 5-minute, if you just want to zoom in and catch a quicker trade, we hit the buy side liquidity. So this high got swept, and then we started coming down, and then we came down to this low. And after we came down to that low, we started going back up. But you don't need to worry about that. All you need to see is after this, we start having a reaction back down, and then we go to this low. Now liquidity moves the same in every single time frame. This is the 5-minute. Now I'm going to zoom into the 1-minute time frame. That was the 5-minute low. Now zooming into the 1-minute time frame, this low gets swept over here, and then we start to have a reaction to this 1-minute high. This is the 1-minute time frame liquidity sweep. What I just showed you before was a 5-minute time frame liquidity sweep inside of a 1-hour time frame liquidity sweep. So liquidity sweeps happen on all time frames. You just need to know which one works for you. Okay, I personally trade on the 1-minute time frame at market open every single day because liquidity sweeps always happen at market open every single day. And this is a beautiful example of that exact thing. So 9:30 was when market opens, which should be right here. Okay, we have a liquidity sweep here like right after market open, and then we start to have a reaction. So what I would do is I would take advantage of this liquidity sweep to catch it to this high, because after we take some sort of high, we usually have a reaction back down, like I said, which we did have a reaction back down. Even if you catch any of these models, you could have caught this liquidity sweep to that high, or you could have caught this liquidity sweep to this low all the way here, or then you could have caught this liquidity sweep again back to this high. You only need one of these a day, and that is exactly why I only trade one trade a day. Here's another perfect example that literally happened the day before. So 9:30 market open is right there. As you can see, we have a high here, which gets swept at market open. Okay, and right after that high, I probably took this trade. This is really clean. So after that high gets taken, we start to have a reaction back down. All you really needed is to catch it to this low. Okay, so you could have caught something like this. Put your stop loss at the high, because you need to put your stop loss at a liquidity level, and then your take profit needs to be down here. Again, we're going to get into the specifics of models later on into this course. Right now, all you need to do is spot liquidity sweeps confidently. Now, just a couple of days before that, here's another example that I have marked out perfectly for you. So 9:30 market opens right there. mark it straight away. And this can happen in the first 10, 20, 30 minutes in the market open. It doesn't has to happen straight away. So liquidity sweep, right after the liquidity sweep, what do we do on the 1 minute time frame? We start to have a reaction back down to go ahead and take this low. Now in this case, I usually probably would target this low, but we still have an internal liquidity sweep here, so this is still a valid model. And you could have targeted here, you could have targeted here, it doesn't matter. Now, literally the day before that, I'm gonna mark this out for you right here. So 9:30 opened here. What did we do when we came up? We took this high, all right? That high got swept at market open again. And then right after we swept that high, we came down and we took this low and this low. I'm pretty sure I caught this trade. I think it's on my Instagram as well. So these two lows got swept and then we started going back up. Okay, so liquidity essentially is like a ping pong level. When we take a high, we can go down to sell side. And then when we take sell side, we might want to go ahead and take either the same high or a different high. Okay, so here, this high actually gets swept by this candle here. And then right after that, what do? We have a reaction to the downside, all right? So liquidity sweeps are all over the market. The bigger the time frame, the more valid the liquidity sweep. So again, the 5 minute, the 1 minute time frame, they're small time frames, but they still are very valid. It's just when we have a bigger time frame liquidity sweep, it's almost a guarantee that we're going to have a reaction up. So this is the 4 hour. If we have a 4 hour sweep, we're probably going to have a reaction up. You, the one who's watching this video, to go ahead and mark a few of these out on your charts, on your market. If you really want to be profitable and you want to make money from trading, you need some homework. So what I need you to do is go to your charts and mark these out at market open. Go to 9:30 New York time, make sure this is set to UTC -4, and mark out at least 5 liquidity sweeps of 5 different days that you recognize. And if you want a more in-depth guide to my strategy, click in the link in the description. Completely free 2-minute guide to my strategy, and I'm going to be coming out with these videos every day.